Namaskaram, my dear friends. So we have understood section 92, which is transfer pricing charging section, which says there has to be associate enterprises. Associate enterprises should have done some international transaction or specified domestic transaction. Then such transaction must happen at arm's length price. Okay. Associate enterprises is defined in section 92A. International transaction is defined in section 92B. Specified domestic transaction defined in 92BA, and arm's length price is defined in 92C. Then there are supporting rules, transfer pricing, reference to transfer pricing officers, determination by APA. Then we are having safe harbor rules. So many things we have discussed so far. Not only that, we have learned how do we apply all these provisions on certain practical situation in the last lecture. So in this lecture, we are not going to talk about the question and answer, but we are going to talk about secondary adjustment. Obviously, when you hear the word secondary adjustment, one question should come into mind. So what was the primary adjustment? So whatever you have learned so far is a primary adjustment. Okay. Determination of difference between arm's length price and a transaction value. Determining the difference between arm's length price and a transaction value, which is going to be done by the AO, is known as a primary adjustment. So we don't do adjustment voluntarily. It is always done by associate. This is always done by assessing officer whenever we deal with associate enterprises at a lower than arm's length price or higher than arm's length price, depending upon the purchase transaction or sale transaction, expense side transaction or income side transaction. So those things we have already discussed. One thing is for sure, transfer pricing adjustment will be done or primary adjustment will be done only when income is increased or loss is a decrease, meaning thereby there is a positive effect on the tax collection. Okay. If income is going to be decreased or loss is going to be increased, then this is a negative effect on tax collection. Then transfer pricing provisions will not be accepted. So what are we going to talk about here? We are going to talk about secondary adjustment. Let me give you one basic example. So this is India. From India, one entity have done sale with associate enterprises in USA. Okay. So this is associate enterprises USA, and they have sold something worth rupees 200 lakh. Whereas this is the transaction value. Okay. Whereas the arm's length price of this particular goods is only 150 lakh. Okay, 150 lakh. They have sold at 200 lakh where arm's length price is 50 lakh. So in India, we have booked more profit. Will you do the transfer pricing adjustment? Definitely no. Because if you do the transfer pricing adjustment, you will try to replace 200 lakh with 50 lakh, and then the profit of Indian entity will go down, and when profit of Indian entity goes down, tax will also go down. So this is not an appropriate example. But what if I make this 250 lakh? The arm's length price is 250 lakh, whereas the transaction value was 200 lakh. That means India should have recorded transaction at 250 lakh, bringing, please understand, bringing the profit. Okay, if I replace the transaction value of 200 lakh with 250 lakh, the profit will have positive impact of 50 lakh, and because of this positive impact on profit 50 lakh, there will be positive impact on tax collection. Computing this difference of positive 50 lakh is known as a primary adjustment. Then what do you mean by secondary adjustment, sir? So Arun Jaitley, sir, in 2017 budget, he said, see, because of your tax manipulation practices, because of your base erosion and profit shifting practices, India has lost a very good amount of revenue. Okay. And we are requesting you as an associate enterprise, you, not government, we don't want that money. You should recover this 50 lakh from the foreign entity. You should recover. You should ask them to transfer this 50 lakh rupees in money to your bank account, because this is the revenue government of India or as a country we have lost, and we don't want with this money. We want this money to be in India, in your own account, but this money should come back to India. Let me give you one expense side example. This is India, and India have made payment for outside India, say for example royalty payment, and we have paid 500 lakh rupees as a royalty to the associate enterprise Germany. Okay, whereas the arm's length price of this particular transaction comes only 100 lakh. Okay, How much excess we have given? Excess we have given 400 lakh. This is the outflow. This is the inflow that did not happen. This is the outflow which has happened. By doing this, Indian entity have booked more expenses. More expenses means less profit. By applying the transfer pricing provision, we will disallow, please understand, we will disallow this 400 lakh, meaning thereby we will add back the 400 lakh to the Indian entity, the total computation. We will compute the tax, we will recover the tax. That's a primary adjustment. Now India is talking to this associate enterprise and they are explaining them, please make sure you bring back this 400 lakh to India, because this is what something excess you have paid, and government as a country, as a government of India, we are losing lot of cash flow because of this type of practices, and definitely we wanted to eliminate the base erosion and profit shifting practices, and we want to discourage this. And not only the discourage and tax collection and adjustment, we want this money back to India. It has to be repatriated to India. This is the law. This is a secondary adjustment. Now you may ask me, sir, what if somebody doesn't do the secondary adjustment? Primary adjustment you do. Secondary adjustment looks very much impractical, because how will you bring 400 lakh to India now? They are my holding company. This is a subsidiary company. A subsidiary company cannot influence holding company. This is the larger entity. This is a smaller entity. A smaller entity cannot influence a larger entity. And even if this is a larger entity and this is a smaller entity, people used to say this particular entity does not exist, or this particular entity is not ready to cooperate. We are not having the associate relation now. So many challenges were there to implement secondary adjustment in real sense, and therefore Nirmala Sitharaman ji has amended the law in Finance Act 2020. Because this is the amended law, obviously this holds little more important as compared to other syllabus that we have discussed in transfer pricing. Now Nirmala Sitharaman ji has given you three options. First option, either bring back this money from this associate enterprises. Second option, if this associate enterprise is not ready to give you money, then bring back money from any associate enterprises. We don't care from where you are bringing money. If this doesn't exist, you bring from somebody else. I don't want to know from where you have brought this particular money to India. This money should come to India. If this money doesn't come to India, then we will consider this as a loan given to foreign entity. So what will happen then? If you are going to deem it as a loan given to foreign entity, then we will deem that this foreign entity is giving you interest, whereas real interest is not given. It will be called as a notional interest, and we are going to charge a tax on notional interest. The interest that you did not earn, on that particular interest we have to charge tax. You need to understand, this is a threat we have given. This is kind of warning we have given to this multinational corporation that no more play with government of India, or no more play in India so far as base erosion and profit shifting strategies are concerned. We are not going to adjust or dilute your strategies now onwards. We are very strict about it, and we have to implement it at very good manner, great manner, to eliminate the overall impact of base erosion and profit shifting practices. So what was the first option I told you? Nirmala Sitharaman said, first bring back it from the same entity. If it is not possible, then bring back from any other associate enterprise. If that is also not possible, then we will give you some lump sum amount of tax, 18% plus some kind of surcharge, and says you pay a lump sum amount of tax and close the matter. So she has given the three options which are more practical now. And if you don't bring till that time, it will be considered as a loan, and we are going to charge interest on that. That means we will consider interest on that, and we are going to charge tax on that interest. So let us discuss all this terminology and the whole procedure of having a secondary adjustment in transfer pricing, section 92 CE. Primary adjustment to the transfer price means the determination of transfer price in accordance with the arm's length principle, resulting in what should happen? Increase in total income, this is first possibility, or reduction in loss, not vice versa, as the case may be in the case of assessee. That means positive impact on tax collection. So what do you mean by secondary adjustment? Secondary adjustment means an adjustment in the books of accounts of the assessee and its associate enterprise to reflect that the actual allocation of the profit between the assessee and the associate enterprises are inconsistent with the transfer price determination. As a result of primary adjustment, thereby removing the imbalance between the cash account and actual profit. Cash balance means they want this particular money back. Okay. So actual profit, once you have done the adjustment, once you have added 400 lakh in profit, this 400 lakh you have added to the profit, but not to the balance sheet cash. No. So they are saying we should show it as a receivable. We should show it balance sheet as a receivable. If you are not bringing it, then till that time we will show it as the advance, we will show it as a receivable, and we are going to charge interest on that. If you bring that money in India, then no further adjustment is required. Forms of secondary adjustment. As per OECD, the Organization for Economic Cooperation and Development, transfer pricing guidelines for multinational enterprises and tax administration. The OECD transfer pricing guidelines. Please understand, the OECD transfer pricing guidelines, secondary adjustment may take form of the constructive dividend, constructive equity contribution, and constructive loans. So according to OECD recommendation, alignment of economic benefit of the transaction with arm's length position. Please understand, alignment means economic benefit. Economic benefit means monetary benefit should happen with arm's length price position. So your country should have that much amount of money as compared to the arm's length price transactions done by your tax department. If there is a difference in cash reserves and profits, then what's the point in having arm's length price mechanism where you will add the profit notionally, but in reality your country will not be benefited out of cash reserves. And unless and until you bring a money to India, obviously a development procedure will be hampered due to this non-availability of the cash or due to this loot that foreigners have done from the India. The provisions of secondary adjustment are internationally recognized and already part of the transfer pricing rules of many leading economics in the world. So we are not the first one to do this, though it is looking very dangerous, and maybe many multinational corporations or foreign country may raise question on this kind of amendments. Don't worry about it. Already developed nations and many other countries of OECD members have adopted this, and other countries are adopting this. Whilst the approach of the secondary adjustment by individual countries vary, it changes from country to country, they represent an international recognized method to align the economic benefit of the transaction with arm's length positions. Obviously, every country is having different methodologies. India is having 3 options. Different countries may have different options of this particular rules. Cases where secondary adjustment has to be made. You don't have choice. It has to be made. And you need to understand this particular situation where secondary adjustment will be recommended by the income tax department and you don't have a choice. In order to align the transfer pricing provision in line with the OECD transfer pricing guidelines and international best practices, section 92 CE provide that assessee shall mandatory be required to carry out secondary adjustment where primary adjustment on transfer price has been made suo motu by the assessee. So assessee has only declared the primary adjustment, still it has to do a secondary adjustment. If not assessee, AO has revised the transfer pricing mechanism. It is determined by advance pricing mechanism, advance pricing agreement entered by the assessee on or after 1/4/2017. Then also transfer pricing secondary adjustment has to be made. It is made as per the safe harbor rule. Even though transfer pricing adjustment has been done according to the safe harbor rule, still you have to make the secondary adjustment. Is arising as a result of the resolution by way of mutual agreement, MAP procedure. Okay, we will learn the MAP procedure in the later chapters. Under the agreement entered into under section 90A for avoidance of double taxation. Whenever a standard double taxation provisions are not helping out assessee, the two countries representative, they will sit together and they will try to resolve double taxation issues. According to that, if some adjustment has been made, still you have to do. So all these are the situations of the primary adjustment. When this 5 situation of primary adjustment has been made, a secondary adjustment has to be made. You don't have choice. Sir, in some cases, this is the relaxation you can say from the secondary adjustment, and monetary limit you have to remember. If your total adjustment value is less than 1 crore rupees, then government say, okay, you are excluded, because we are not targeting a small assessee, we are targeting large corporate, multinational corporates. So if your transaction value, such secondary adjustment, however, shall not be carried out if the amount of primary adjustment in the case of the assessee in any previous year does not exceed 1 crore. Obviously, if it is the transaction value itself, if the primary adjustment itself is less than 1 crore, then there is no requirement to have the secondary adjustment. And if you have done the primary adjustment prior to 16-17 assessment year, because this amendment have taken place from 17-18, so up to 16-17, if the primary adjustment has happened, secondary adjustment is not a retrospective amendment, it is a prospective amendment, so it will applicable only to the future transaction, not to the past transactions. No repatriation of the excess money by the associate enterprises shall be deemed to be an advance. So this is the consequence. If you do not bring back the money, then it will be considered as a loan in your balance sheet. If this is your balance sheet, it will be considered as a loan and advance, and we will assume that you are earning an interest, though in reality you are not earning an interest, but we will assume you are earning an interest, and from Indian associate enterprises we will take tax on that particular interest. Okay, so first of all, they are not able to recover the money. Indian government is torturing them to bring back the money, and if you don't bring back within the 90 days, so there is a timeline you have to remember, within 90 days, then we will consider it as a loan, and after considering as a loan, we have to charge interest on that. Okay, look at this. Where as a result of primary adjustment to the transfer price, there is an increase in total income or reduction in the loss, as the case may be, the assessee, the excess money or the part thereof, as the case may be, which is available with its associate enterprises, if not repatriated to India within the time as may be prescribed, that is 90 days, shall be deemed to be an advance made by the assessee to such associate enterprises, and the interest on such advance shall be computed as the income of the assessee in the prescribed manner. So we will see those rules. Such excess money or part thereof may be repatriated from the associate enterprises of the assessee is not resident in India. Please understand, such excess money or part thereof may be repatriated from any associate enterprise. So it can be, if the first AE is not giving you the repayment, you can bring back from another AE. But whenever I draw this, please understand, first AE or the second AE should be outside India, you know. If you are bringing this particular adjustment from AE to AE in India, so as a country we have not gained anything. We want this money from outside India to India, either from the same AE or any other AE which is not a resident in India. Okay. So what do you mean by excess money? Excess money is nothing but a primary adjustment. Excess money means the difference between the arm's length price determined in a primary adjustment and the price at which the international transaction has actually been taken place. Arm's length price minus transaction value is equal to excess money. Okay, but don't by heart this format, the difference. Okay, it should be the difference. You should know it as the difference between these two prices. So time limit for repatriation. As I told you, Rule 10CB says the money has to be repatriated within the 90 days from the date given in column 3. So column 3 of the table that we are going to look now is the due date. Within that due date, the money should be repatriated. Okay, and the situations are written in column number 2. The period from which, if it is not repatriated within 90 days, then we have to start charging the interest. Then interest start date should be given in column number 4. Okay, so column number 4 is having your interest date, and column number 3 is the date from which 90 days period will start. Okay, so column number 3 period from which 90 days period will start. Within this period, if money comes, no problem. If in this period money doesn't come, then from column number 4 onwards, interest will start. Let's look at the first situation where the primary adjustment is done by suo motu by the assessee. So assessee himself had done this adjustment. Obviously, this adjustment will be done in ROI. So the 90 days period will be counted from the due date of filing the return under section 139(1). So this is the 90 days the period will be counted after the due date. And sir, if you don't bring within 90 days, it's not that the interest will be starting after 90 days. No. Government have not given any concession from the interest collection. Please understand, the interest will start from the due date of filing of return itself. So if your due date is a 30th November, because in many cases your due date will be 30th November, from 30th November you brought money within 15 days, 20 days, 40 days, 60 days, 85 days, there won't be any consequences. You bring that money back. Imagine you did not bring that money back in India, but you took 140 days to bring that money back in India. The interest will be computed for 140 days. Please understand, 140 days means the month we have to consider, but I am telling you it is not for excess. We are not going to subtract 90 days from that and compute the excess number of days. No. Interest will be computed from the due date. No concession in interest. If the primary adjustment to the transfer pricing done by the AO or the appellate authority, which has been accepted by the assessee, is not challenged by the assessee, he has not put the case in court, then the date of said order, from this order date it should be in 90 days, he should bring back the money. If he doesn't bring back that money in 90 days, if money is not repatriated, then from the same date interest will be leviable to the date of repatriation. Okay, where the primary adjustment of the adjustment to the transfer price is determined by the advance pricing agreement, APA. Okay, then what should happen? Now there are different situations. If APA has been entered into on or before the due date of filing of the return, so APA was done before the due date, obviously then effect must have been given in ROI. Then date of filing of the return, on which date you have filed the return, that date, from that date 90 days we have to consider. And if you did not bring this money within 90 days, then from the due date of the filing of the return we have to consider. Now you can file, please understand, you might have filed this particular return before the due date or after the due date, that is actual filing date. From that 90 days period will start, but the interest period will start from the due date. Otherwise what assessee will do, they will try to file return late. If they file the return late, and if we start from date of filing the return, then people will be saving money on the interest. So we said no, we will only focus on due date. Okay, if you have filed belated return, say for example in the month of March you have filed the return, no, but your due date was in November, so from November interest will be computed. If APA has been entered into or after the due date of filing of return, the end of the month in which APA has been entered, because now you cannot take base of ROI. First ROI has been filed and then return has been filed, and the end month when APA has been entered, so same period. So from the end of the month when APA was entered, from that 90 days we will be considered. Where the option has been exercised by the assessee as per the safe harbor rule, the due date of the filing of the return and the due date of filing of the return. So according to safe harbor rule, you will obviously follow the rule in your ROI. Where the primary adjustment of the transfer price is determined by the resolution by following the MAP procedure. Okay, MAP means mutual agreement procedure. Two countries representative will sit together and they will bring the double taxation avoidance arrangement for you. So in that case, where date of giving effect by the AO under rule 44H of such resolution. So whenever AO has given the effect, from that effect date 90 days, and if you don't bring this particular money within 90 days, then from the same date the interest will be calculated. Sir, now period of interest and 90 days period you have understood from different perspective. Now what we have to understand, what will be the rate of interest. So in this whole para they are writing rate of interest as prescribed, but we will discuss that. Now loan can be in two currency. Loan can be either in foreign currency or it will be in rupees. And we are computing notional interest. That means there won't be any actual interest written in the law. It's not a real loan given by us, Indian Associate Enterprise, to foreign entity. Therefore, we have to take a reference of Indian bank, and that bank is SBI. And in salary chapter, we have done the perquisite valuation. There also, we have taken the first day rate of interest, isn't it? First day of the previous year, the rate of interest which is prevailing on the first day of the previous year, same we are going to take here, where the international transaction is executed in Indian rupee at the 1 year marginal cost of the fund lending rate of SBI. So we have to take 1 year. In India, we don't have 3 month and 6 month rate. We are having all the rates annually only. So SBI rate as on 1st April of the relevant previous year, not assessment year, plus 3.25. Plus 3.25, that means it's not SBI rate. If SBI rate is 10%, then the interest rate that we are going to charge here or we are going to consider here is 13.25, higher than SBI rate, and this 3.25 by default you have to remember. There is no other choice. You have to remember this particular table. Sir, but when the loan is taken in international currency, foreign currency, then LIBOR is a base rate that we have to consider, and because LIBOR is given for 1 month, 3 months, 6 months, so we are taking the 6-month LIBOR rate, not at the beginning, not at the end. We are taking as on 30th September, which will give us more relevant interest rate. Okay, so where it is in foreign currency, a 6-month London interbank offering rate, please remember, and you must have learned it in international taxation, though it is 6-month rate, okay, the LIBOR will always be given in per annum percentage. So if it is 8%, it is 8% per annum, but this is applicable for 6-month loan. For 3-month loan, it may be 7% per annum. Interest rates are always written in per annum terminology. Okay, so that interest rate you will take, in that you have to add another 3%. So Indian rupee plus 3.25%, foreign currency plus 3%. This is the rate of interest you need to remember, my dear friends. Okay. So, but when loan is in India, we know the principal amount is 10 lakh. But when loan is in dollar and principal amount is 1 lakh, we cannot compute interest on dollar and then we will have the dollar in our hand. But we want amount in rupees because the taxation will be collected in rupees. So this dollar has to be converted in Indian rupee. So what should be the exchange rate? So there are TT buying rate and TT selling rate. So we have to take here TTBR buying rate. Please understand. The rate of exchange for the calculation of value of international transaction denominated in the foreign currency shall be the telegraphic transfer buying rate, lower rate, not the higher rate. See, if 60/64 is written, this is the buying rate and this is the selling rate. This much foreign taxation or international currency values you should understand. So we have to focus on buying rate. On the last day of the previous year in which such international transaction was undertaken. So on the last day, interest we have to take from the first day, Indian rupee, 30th September for LIBOR, and buying rate we have to take from the end. So we are taking three items from 3 different corners. Indian currency first day, LIBOR mid of the year, and foreign exchange rate end of the year. Okay. So this is the option which is brought by Nirmala Sitharamanji, and thank God she has brought the option, because this Indian AE said, no, we cannot bring this money back from the associate enterprises with whom we have done the transaction. The second option that you have given us, bring it from another associate enterprise, even that is not also logical. We cannot bring this money to India, ma'am. Definitely we are helpless. Now what can we do? Either you kill us or we are going outside India. Then they come up with an alternative mechanism. Okay, if you don't want to bring this particular money to India, because government as a whole, we are going to lose money, and country as a whole, we are losing the resources, you have to pay additional amount of tax. Okay, this is the penalty tax kind of, you can say. Option to pay additional income tax if the excess money is not repatriated. In a case where excess money or part thereof has not been repatriated within the prescribed time as mentioned above, the assessee has the option to pay additional income tax at the rate of 20.9664, but this you cannot buy heart. So tax rate is 18% plus by default surcharge of 12% plus by default cess of 4% on such excess money or part thereof. Again, very important amendment of current year. Remember this. Where additional income tax is so paid, he will not be required to make secondary adjustment and compute the interest from the date of payment of such tax. Till that we have to consider the interest. This implies he would in case be required to compute interest up to the date of payment of such additional tax. The additional income tax paid, sir, is it like a TDS? Will somebody get credit? No. Sir, will he get any, is it like a self-assessment tax or advance tax? No. This is additional amount of tax you have to pay and forget. Okay. So the additional income tax so paid by the assessee shall be treated as a final payment of the tax in respect of the excess money or part thereof, not repatriated, and no further credit would be allowed to the assessee or any other person in respect of such amount of additional income tax so paid. Further, no addition in respect of amount on which such additional income tax has been paid would be allowed under any provisions of the Act. So you cannot say, sir, you are not treating as a self-assessment tax, not treating as an advance tax, is not also TDS. At least treat it as an expense and give me the deduction, because I am making the payment. even deduction is not allowed. Forget about the credit and all, even deduction of this particular expenditure is not allowed. It's just the extra burden that you are paying from your pocket. No sir, who will pay 20% additional tax on the transaction value of 1000 crore? Then bring back the 1000 crore to India, isn't it? Either you bring that 1000 crore to India or you pay 20 point that percentage of the tax to India. Choice is yours. Okay. So this is what you need to remember. Primary adjustment is nothing but a TPI adjustment that we have learned, and secondary adjustment has given you three effects. Bring back from that money, repatriate that money from the same associate enterprise. If not, then bring back from any other associate enterprise which is non-resident, it's not resident in India. If not, then this will be treated as a loan. Because it is treated as a loan, there will be interest charge, and if it is the Indian rupee, if it is in rupee, then interest rate will be SBI rate plus 3.25% will be charged. Okay, if you don't bring within the 90 days in India. If it is in dollar or foreign currency, then LIBOR plus 3% per annum. On September, we have to consider this much interest rate will be charged, or interest will be computed, on that tax will be computed. But this is complete harassment, so we are not able to do this. Then you can pay additional tax. Additional tax will be paid as an optional, okay, at the rate of 18% of the transaction value, the secondary adjustment, plus 12% surcharge, plus 4% cess, and this is the final payment. No credit, no deduction. Okay, thank you.